During the pandemic, while millions of Americans stood in line for unemployment benefits, some billionaires saw their wealth increase by tens of billions. Jeff Bezos grew richer as Amazon's orders exploded, and Elon Musk accelerated as Tesla's stock price skyrocketed. Money doesn't disappear, it simply changes direction and often flows into the pockets of those who understand the game's rules. The problem is, these rules aren't taught in school. The finance, taxation, and investing systems have hidden principles that only a small group knows how to use. They don't just work hard, they set the rules, control the money flow, and seize opportunities to leap ahead. If you don't realize this, you'll spend your life building someone else's dream. But if you understand and apply it, you can reverse the game, going from chasing money to having money chase you. Today, we'll break down 15 hidden principles that America's ultra-wealthy live by, and how you can start using them to change the game for yourself. Number 1. Money loves speed. The system wants you to slow down. In the world of finance, speed determines who wins. When the U.S. market shakes from bad news, significant investment funds and the wealthy place buy or sell orders within minutes, even seconds, before that news reaches the public. Meanwhile, the average person is still reading the headlines, debating online, or waiting for the safe moment. The system is designed to keep you slow. Banks take days to process your withdrawal, yet they invest that money instantly. Your mortgage loan might take weeks to approve, but private investors can mobilize millions of dollars within hours. Wealthy Americans always keep liquid cash or credit lines ready to seize opportunities immediately. When the Silicon Valley banking crisis hit, some tech entrepreneurs instantly bought up shares or assets at bargain prices before the market could reprice them. The lesson: don't let procedures and hesitation make you miss out. Prepare flexible capital and build connections to access information and deals before they go public. In the money game, being one step slow can cost you the whole board. Number 2. Inflation is a wealth-building tool. For most Americans, inflation feels like a slow, creeping disease. Gas prices go up, rent climbs, grocery bills get heavier, while wages barely move. They feel like they're being bled little by little. But for the wealthy, inflation is a silent money-printing machine if you know how to use it. The principle is simple: debt gets cheaper over time. Imagine an investor buys a building in Texas for $5 million, taking a $3 million fixed-rate loan from the bank. When inflation rises, the building's value could jump to $6 or $7 million, but the loan is still $3 million. They've just increased their net worth without lifting a finger. American entrepreneurs also use inflation to pass the burden onto consumers. When the cost of materials and services rises, they raise their prices. Revenue goes up, but their long-term debt stays fixed in terms of today's money. The result: profits swell. Shareholders in public companies benefit too. During 2021-2022, when prices soared, many U.S. companies reported record revenues, pushing both stock prices and dividends higher. The middle class, however, often does the opposite, leaving money in savings accounts or spending it the moment extra income comes in, unintentionally standing on the losing side of value erosion. If you want to be on the winning team in the inflation game, you need to hold assets that appreciate: real estate, stocks, or businesses. Inflation isn't always bad. It's only dangerous if you're on the wrong side of the money flow. Number 3. Don't hold money, keep it moving. Most middle-class Americans are taught, save your money to stay safe. However, the wealthy think the opposite. Money sitting still is losing value. Inflation erodes purchasing power daily, so instead of letting it sleep in a bank account, they ensure every dollar has a job to do. Their rule is simple: every dollar is either earning income or buying an asset that can appreciate. When they sell a business, they don't let the cash rest for a few months before deciding what's next. They immediately move it into rental real estate, dividend-paying stocks, or invest it in a new business venture. For example, an investor in California sells an apartment complex and pockets $2 million. Instead of putting it in the bank, he uses a 1031 exchange, a tax-deferred property swap, to buy another commercial property immediately. This way, the money avoids immediate taxation and generates a monthly cash flow. The wealthy also keep their money moving through alternative investments, artwork, venture capital funds, or corporate bonds. The goal isn't just profit-making, ensuring that money is always running faster than it loses value. Meanwhile, most American employees let their cash sit idle in savings accounts, waiting for the right time to invest, and that time often never comes. The lesson is clear. Don't let money sit still if you want to be wealthy. It must move, earn, and work for you, even while you sleep. Number 4. Stocks aren't risky if you buy the right way. Many Americans treat the stock market like gambling, buying when prices are hot, panic selling when the market drops, constantly chasing news and rumors. The result? They lose money and conclude that investing in stocks is too risky. But the wealthy take a completely different approach. They don't just buy stock tickers, they buy entire businesses. The wealthy focus on companies with solid foundations, consistent profits, positive cash flow, essential products or services, and strong leadership teams. They buy when prices are reasonable, often when the market is pessimistic, and then hold for the long term, letting time do the most challenging work, growing value. For example, in 2009, an investor in New York bought Apple shares at around $14 per share when the market was fearful, adjusted for splits. Without constant trading, he held for over 10 years. The result, the investment multiplied many times with reinvested dividends, further boosting total value. The wealthy understand that short-term volatility doesn't equal risk. The real risk is buying the wrong business or selling too soon. Instead of flipping stocks for quick gains, they choose a buy-and-hold strategy with companies they believe will survive and grow for decades. If you treat the stock market like a casino, you'll get gambling results. But if you see it as an opportunity to own part of the world's best businesses, stocks become one of the safest and most powerful wealth-building tools. Number 5. Investing in hard-to-access assets. America's ultra-wealthy don't stop at stocks or real estate. They also own hard-to-buy assets that most everyday people have never even heard of, let alone invested in. These low-liquidity assets require large amounts of capital or special connections to access, but they have the potential for exceptional returns. For example, in Los Angeles, investors quietly purchased original Jean-Michel Basquiat paintings from the 1982nd. When the art market exploded, each piece's value multiplied many times. They didn't display the works publicly, but stored them in climate-controlled, fully insured facilities. Years later, when they sold through major auction houses, the profits were enough to purchase an entire high-rise building. Another example is rare wine investment funds in Napa Valley. Large quantities of vintage Bordeaux and Burgundy were acquired, stored under strict conditions, and sold only when prices peaked. In the high-end wine market, values can rise steadily by 8–12% annually, almost wholly detached from stock market volatility. Other hard-to-access assets include music, royalty rights, vintage car collections, and even strategically located land for renewable energy projects. These investments aren't listed on public exchanges. They're usually bought and sold through private networks or specialized brokers. The common traits of these assets are: they appreciate over time due to scarcity and high demand. They're less affected by short-term economic swings. They require deep expertise and a long-term holding strategy. The wealthy aren't looking to buy low, sell high. immediately. They buy to hold for years, even decades, letting the asset rest until it reaches peak value. If you want to enter this world, start by gaining specialized knowledge in one type of asset, building relationships with people already in the game, and patiently waiting for the right moment. With the right strategy, today's hard-to-access investment could become a silent money-printing machine. Number 6. Earning from interest, not just from assets. The wealthy in America understand one key principle. Real money doesn't just lie in the value of the asset itself, but in the steady income that asset generates. They don't just buy real estate to wait for its value to rise, they turn it into a source of passive income every month. For example, a group of investors in New York purchased an entire apartment building in Brooklyn. Instead of selling as soon as prices increased, they rented out each unit. The monthly rental income was enough to cover the mortgage interest, maintain the building, and leave a net profit. More importantly, the property's value continued to increase over time, meaning they enjoyed both cash flow and appreciation. This principle applies across many asset classes: dividend-paying stocks, corporate bonds, music royalty rights, and even mortgage lending. The goal is to own assets that generate consistent income, rather than relying solely on selling them to make money. The wealthy don't just think, "What do I own?" They also ask, "How much does it bring in each month?" And it's precisely this steady cash flow that forms the foundation for maintaining and expanding their wealth across generations. Number 7. Investing in political influence. America's ultra-wealthy understand that the rules of the economic game don't just appear on their own. Those in power write them, and whoever can influence them holds the advantage. That's why they don't just invest in stocks or real estate, but also invest in political relationships. A prime example is that large corporations in Washington, D.C. always maintain teams of lobbyists whose sole job is to connect with lawmakers and officials. They fund election campaigns, participate in policy conferences, or support local community projects. The goal isn't just to be friendly, but to shape tax laws, business regulations, and industry policies to benefit them. For instance, a renewable energy company in California spent millions of dollars lobbying the state government to implement tax incentives for clean energy. The result? Thanks to the new supportive policies, they saved tens of millions in costs and rapidly expanded their market share. The wealthy view this as a long-term investment, spending money and effort to create the rules of the game in their favor, allowing them to profit for years. This explains why significant investment funds, tech giants, and Wall Street firms strongly influence political activities. The takeaway for us: if you can't directly engage in political lobbying, at least monitor upcoming policy changes closely and invest ahead of the trend. When the rules change, money flows to those prepared as soon as possible. Number 8. Scarcity is an illusion. Most people believe not enough is reality: money, opportunities, and time. But America's ultra-wealthy understand that scarcity is often just a story we tell ourselves, not an absolute truth. Take investing as an example. During the 2008 financial crisis, many believed the real estate market had completely collapsed and that all opportunities were gone. However, savvy investors such as private investment groups in Texas or New York saw prime land selling at 40–60% discounts. They bought when the crowd was fearful, and a few years later, their assets doubled or even tripled in value. Similarly, business opportunities never truly disappear, they shift. When one industry contracts, another emerges. For example, as traditional brick-and-mortar retail stores shut down in droves, e-commerce exploded. Many American entrepreneurs quickly pivoted to selling online, from fashion to food, earning millions in just a few years. Money, knowledge, and opportunities always exist somewhere, just waiting for those fast and alert enough to spot them. The wealthy don't wait for a sign that says opportunity here. They actively create or identify it before the masses catch on. The takeaway: don't limit yourself with a scarcity mindset. Focus on finding where the money is flowing and move with it. How you seek and capture opportunities will change completely once you shift from a scarcity mindset to an abundance mindset. Number 9. Your spending habits feed them. When you swipe your card for a coffee, order food through an app, or upgrade your phone, someone else is profiting from that action. The wealthy in America understand that the spending habits of the masses are the most stable and long-lasting source of income. For example, major coffee chains like Starbucks don't just sell drinks, they sell a morning ritual. Apple doesn't just sell phones, they've created an upgrade cycle that brings customers back every 1-2 years. Netflix, Spotify, and Amazon Prime have turned monthly subscription fees into massive recurring revenue streams. The wealthy aren't just customers of these brands, they own shares. Every time you spend money, a portion flows into their pockets as dividends or increased stock value. The lesson here is crystal clear. Either you remain in the payer role or learn how to own a piece of the businesses you spend money on. From the wealthy's perspective, spending cash is normal, but turning other people's spending habits into your income, that's the real game. Number 10. They control your attention. Attention is the most powerful currency in today's economy, and the wealthy know it well. They understand that when caught up in endless breaking news, short videos, or entertainment shows, you have less time and energy to think about building wealth for yourself. Major media corporations in the US, from Netflix and Disney to social media giants like Meta, Facebook, Instagram, and TikTok, all operate on one principle: keep you online for as long as possible. Every minute you watch is another minute. They collect data, sell ads, and boost profits for their shareholders, the wealthy, who hold control. For example, while you spend hours scrolling or binge-watching, investors like Warren Buffett are making money from the very companies providing the content you consume. I don't believe entertainment is bad, but if it takes over all your time and mental space, you'll fall right into the trap they've set. The wealthy use social media as a tool, while most others use it as an unconscious habit. To escape this control, actively manage your online time, filter the information you consume, and devote the best of your attention to learning, creating, and investing. Because whoever controls your attention controls your wallet. Number 11. Life insurance as a private bank. Most Americans think life insurance is just a payout when you die. However, the wealthy use it as a personal banking system to protect assets and generate cash flow. They choose types of life insurance that build cash value, such as whole life or indexed universal life, IUL. With these policies, a portion of the premium goes into a cash value account. This amount grows at a fixed interest rate or based on a market index, tax-free, and can be borrowed against at any time without bank approval. For example, an American entrepreneur holds a whole life policy worth several $million. When he needs quick investment capital, he borrows directly from the policy's cash value at a low interest rate, without affecting his credit score, and more importantly, the principal inside continues to grow as if it were never withdrawn. This creates a double benefit. The money is being used while still compounding in growth. This strategy is brilliant, but it's not for everyone. The initial premiums are pretty high, and the policy can lapse if you can't maintain them long term. However, suppose you have the financial capacity and know how to manage it. In that case, this financial tool is almost bankruptcy-proof. The money is always protected, accessible, and not taxed, like withdrawals from a regular investment account. The wealthy buy insurance to cover risks and use it to leverage tax laws and preserve capital. While most people see it as an expense, they turn it into a flexible capital source, freeing themselves from dependence on banks and always staying ready to seize opportunities. Number 12. Crisis is a wealth transfer opportunity. Most Americans see an economic crisis as a disaster: job losses, falling asset values, and market panic. But for the wealthy, it's a rare discount season to buy assets at bargain prices. In reality, money doesn't disappear during a crisis. It simply moves from the hands of the fearful to the hands of the prepared. When the market plunges, the majority sell off to protect whatever profits they have left. At the same time, wealthy investors use their cash reserves to buy blue-chip stocks, real estate, or even entire businesses for a fraction of their previous value. For example, during the 2008 financial crisis, American investors acquired dozens of hotels and office buildings in major cities at more than 50% off. Just a few years later, as the economy recovered, their values doubled, generating hundreds of millions of dollars in profit. A crisis is not the time to be afraid. It's the time to make the most rational decisions. The difference is that the wealthy are always prepared. They keep cash on hand, limit bad debt, and maintain a buy list of desired assets in advance. When opportunity comes, they don't hesitate. If you want to play by this rule, start by building an emergency fund and closely monitoring the market. A crisis will come sooner or later, and those with cash will become the most powerful buyers when it does. Number 13. Rarely using their cash. One of the secrets to how the ultra-wealthy preserve their wealth over the long term is that they rarely use personal cash for significant expenses. Instead, they use existing assets to generate cash flow or leverage financing. For example, rather than spending $200,000 out of pocket to buy a luxury car, they might have the company lease it, turning it into a legitimate business expense to reduce taxes while keeping their cash untouched. Or, when buying a vacation property, they don't sell profit-generating stocks for the funds. Instead, they use those stocks as collateral for a low-interest loan. This way, the original assets continue to appreciate while they still have money available to spend or invest. In the US, many entrepreneurs even use dividend income, rental income, or business profits to pay for luxuries like yachts, private jets, or vacation villas. This helps them stick to the golden rule: money must always be working. This mindset is very different from the majority. Many working people will drain their savings to buy a dream item, then spend years rebuilding their savings. The wealthy, however, understand that keeping money in a productive state is more important than the feeling of owning it immediately. If you want to apply this principle, learn how to make your assets pay for expenses instead of relying solely on your labor. That way, every major purchase will stop being a burden and result from an innovative financial system. Number 14. Focus on ownership, not just income. Most people are taught that to get rich, they need to earn more money, work overtime, chase raises, or switch to higher-paying jobs. But the ultra-wealthy understand that a high income doesn't necessarily lead to lasting wealth. What they prioritize is ownership. Ownership can mean shares in a company, rental properties, a brand, or intellectual property rights. The common factor is that these assets generate cash flow even when the owner isn't actively working. For example, a highly skilled American engineer might earn $200,000 a year, but the income stops immediately if they quit their job. Meanwhile, someone who owns 10 rental properties, bringing in $20,000 a month, can travel the world for a year and still have money flowing into their account. High income is like a river that only flows when it rains, utterly dependent on your current job. Ownership is like a massive reservoir. Once it's full, there's always water to use, rain or shine. In the US, many ordinary people have shifted from simply working for a paycheck to accumulating assets. They start small, buying dividend-paying stocks, investing in REITs, or taking equity stakes in promising startups. If you want financial freedom, ask yourself, is every dollar I earn today feeding my consumption or building ownership? Because income stops when you stop working, but ownership will keep paying you for life, even for the generations after you. Number 15, they sell you the very lifestyle you dream about. Major corporations in the US don't create new desires out of thin air. They tap into wants that already exist. To be more attractive, wealthier, healthier, more successful. Then they package those desires into products or services and sell them back to you. You want to be healthier? They sell you supplements, gym memberships, and workout apps. You want to be successful? They sell you get-rich courses or productivity tools. You want luxury? They sell you Louis Vuitton bags, Rolex watches, or Tesla cars. Each product has a story and an image of the person you could become if you own it. In America, this massive lifestyle industry runs like a loop. You feel something is missing to an ad appears to you. Buy a product to fill that gap, to the satisfaction quickly fades, to the loop starts again. Truly wealthy people are usually on the side that creates and sells the dream, not just consumes it. For example, they invest in cosmetic brands instead of skincare products. Instead of just buying concert tickets, they take equity in the event production company. The lesson is, if you stay in the role of customer forever, you're fueling someone else's dream. To build lasting wealth, find a way to be on the side of the dream seller, where every trend and every desire of the masses becomes an opportunity for you to create value and profit. Money always operates under rules that most people are never taught in school and will never read about in the news. The wealthy aren't necessarily smarter, but they know the rules, and more importantly, they play the proper role, the one that controls assets, cash flow, and influence. If you only focus on earning more income without thinking about ownership and consuming without finding a way to be on the supply side, no matter how hard you work, the game will still be stacked against you. Personal viewpoint. I believe understanding and applying the principles in this video can help you shift from being a follower to a leader. You don't need to apply them all at once. Start with one principle, practice it consistently, and gradually expand your financial mindset. Now is the time to take action. Comment. Which principle in this video is most worth applying to your life? Like if you want more people to understand the rules of money. Share with your friends so they won't be disadvantaged financially. Subscribe to the channel so you don't miss practical financial and investment strategies. The greatest asset you can own today is knowledge. You've just added an essential piece to yours.